Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how economic indicators shape your investment decisions in 2024. Understanding economic indicators is crucial for anyone looking to make smart investment decisions. These indicators, like GDP growth, unemployment rates, and inflation, can signal the health of the economy and shape market trends. Investors rely on these metrics to guide their choices, whether they're buying stocks or exploring real estate. Ignoring them could mean missing out on potential gains or exposing yourself to unexpected risks. In this video, we'll break down key economic indicators and show you how to interpret them. By the end, you'll have a clearer picture of how they impact your investment strategy, helping you navigate the markets with confidence. Let's dive in. What are economic indicators? Economic indicators are critical statistics that offer insights into the state of the economy. They help investors, policymakers, and businesses make informed decisions. Understanding how these indicators work can guide investment strategies and foster better economic predictions. Economic indicators are generally categorized into 3 types: leading, lagging, and coincident indicators. Each type serves a unique purpose and provides different insights into economic health. Leading indicators. Leading indicators are metrics that tend to change before the economy as a whole changes. They serve as early signals of future economic activity. By analyzing these indicators, investors can often predict peaks or troughs in the economy. Here are a few examples. Stock market performance. A rising stock market often signals growing investor confidence and suggests that economic growth is on the horizon. Consumer sentiment. Surveys that gauge consumer confidence can predict spending patterns. When consumers feel optimistic, they are more likely to spend, which can boost the economy. New housing starts. An increase in new residential construction often indicates future economic growth, as it suggests that more people expect to buy homes. Recognizing leading indicators can give you a heads up about economic shifts, allowing you to make timely investment decisions. Lagging indicators. Unlike leading indicators, lagging indicators follow economic changes. They confirm trends but do not predict them. Understanding lagging indicators helps investors understand what has already happened in the economy. Some typical examples include unemployment rates. High unemployment often reflects a struggling economy. These rates typically react to economic changes after they occur. Corporate profits. A decline in corporate profits may indicate that businesses are struggling, which often follows a downturn in economic growth. Consumer Price Index, CPI. This measures inflation and typically changes after economic conditions have already shifted. These indicators are essential for analyzing historical economic performance but are not as useful for making proactive investment decisions. Coincident indicators. Coincident indicators move in line with the economy and can provide useful information about the current state of economic performance. These indicators help investors understand what is happening in real time. Key examples include gross domestic product, GDP. This is a primary measure of economic activity. Rising GDP indicates growth, while falling GDP suggests contraction. Retail sales. Fluctuations in retail sales reflect consumer spending trends, making it a reliable indicator of current economic health. Industrial production. Changes in industrial output often align closely with economic cycles, providing a snapshot of the manufacturing sector. By keeping an eye on coincident indicators, investors can gauge the current economic climate and make informed decisions based on the present scenario. Understanding economic indicators and their types is vital for anyone looking to invest wisely. By paying attention to these metrics, you can enhance your ability to anticipate market changes and improve your investment approaches. Key economic indicators influencing investment decisions. Understanding key economic indicators is crucial for making informed investment decisions. These indicators offer insights into the current state of the economy and can help investors gauge market trends. Here's a closer look at the most impactful indicators to monitor. Gross domestic product, GDP. Gross domestic product, or GDP, measures the total value of all goods and services produced in a country over a specific time frame. To calculate GDP, economists consider all economic activities, including consumer spending, business investments, government spending, and net exports. Significance. GDP is often seen as a barometer of economic health. A rising GDP indicates a growing economy, which may signal more opportunities for investments. Conversely, a declining GDP can suggest economic troubles, prompting investors to reconsider their strategies. Monitoring GDP helps you understand whether the economy is expanding or contracting, guiding your investment choices. Inflation rate. The inflation rate tracks how much prices for goods and services rise over time. Essentially, it tells you how much your dollar shrinks in value. Impact on purchasing power. When inflation is high, the money you have buys less. This can eat into investment returns, making it vital to consider when selecting assets. If the inflation rate exceeds the return on your investments, you lose purchasing power. Investment returns. Savvy investors often seek options that can outpace inflation, like stocks or real assets. Understanding the inflation rate can lead to smarter investment choices. Unemployment rate. The unemployment rate reflects the percentage of people unable to find work in the labor market. High unemployment can signal economic weakness, while low rates suggest a robust job market. Consumer spending. When more people are employed, they spend more, boosting economic growth. Conversely, high unemployment can lead to reduced spending, impacting businesses and investment opportunities. Economic growth. Tracking employment trends can help you predict broader economic changes. If unemployment falls, investor confidence may rise, leading to market upswings. Consumer Confidence Index, CCI. The Consumer Confidence Index measures how optimistic consumers feel about the economy's health. Higher confidence typically indicates that people are more willing to spend money. Influence on market trends. When consumers feel good about their finances, they're more likely to invest in goods, services, and even stocks. This can lead to a positive ripple effect in the market, where higher spending improves company revenues. Investment strategies. Investors often look at CCI to adjust their portfolios. If confidence is rising, it might be a good time to invest in companies that thrive in a strong consumer environment. Interest rates. Interest rates are the cost of borrowing money. They influence everything from mortgage rates to the return on savings accounts and bonds. Relationship with investment costs. When interest rates are low, borrowing is cheaper. This often leads to increased business investments and consumer spending, fueling economic growth. On the flip side, high interest rates can slow down borrowing and spending, leading to less economic activity. Bonds and equities. Investors need to keep a close eye on interest rates. When they rise, bonds become more attractive due to increased yields, while stocks might take a hit. Understanding this relationship can guide you in making strategic investment decisions. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.